top of the class on the road, hey, and it's time to run it up, yeah, you know, yeah. Mask down, put the pedal to the floor, yeah. On the road, here we go, here we go.
What is going on, everybody? Welcome back to the channel. My name is Frankie Candles, and today we're gonna take a deep dive into a more advanced connect known as the Wyckoff distribution. Before we jump into it, be sure to join the Candle Mafia by liking, subscribing, hitting that notification bell, and heading over to frankiecandles.com to check out our latest deals on trading. Let's jump into it. The creator of this concept, Richard DeMille Wyckoff, was an American stock market investor and early pioneer in technical analysis, a godfather if you will. As a child, he was absolutely fascinated with the stock market. When he was 15, he was a stock runner running back and forth between firms carrying documents. He even opened up his own brokerage firm in his mid-20s. He's written a plethora of books over the years on market behavior, how to time the market, methodology, and much more. Two books that I would highly recommend is My Secrets of Day Trading in Stocks and How I Trade and Invest in Stocks and Bonds. If you're a big chart nerd like myself, you'll see that the concepts and strategies that he used back in the day are very much relevant in today's markets, crypto included. Although he passed away over 88 years ago, his famous method, the Wyckoff distribution or Wyckoff market cycle, still helps people time the market with precision. Before I jump into the stages of the Wyckoff distribution, there are two main rules. These are from the book Charting the Stock Market, The Wyckoff Method by Jack Hudson. Rule number one is that the market never behaves the same way twice. This goes hand in hand with the famous phrase, history doesn't repeat itself, but it often rhymes. Rule number two is relevant to rule number one. It's that since every move is unique and nothing is predetermined, the analytical importance of today's price action is significant when compared to what the market did yesterday, last week, last month, and so on. Every move the market makes has to be compared to what it did before. The Wyckoff cycle has four distinct phases: accumulation, markup, distribution, and markdown. So let's jump into the charts so we can go back in time and I can show you guys the different phases of the Wyckoff distribution pattern. Let's get into it. So guys, here we are on the Bitcoin daily chart. And I just kind of want to try to point out to you guys the different phases of this Wyckoff distribution pattern. And as you know, we talked about four different phases. There's accumulation, markup, distribution, and markdown. Now, I do want to hammer home that this is a much more advanced concept. So we're going to cover the very, very basic surface levels of the Wyckoff distribution. But like I said, we mentioned those four different phases, and I kind of just want to show you guys how these can play out on the charts. So here we are on the Bitcoin daily chart, and you can see right here, this would be considered an accumulation phase, right? So with the accumulation phase, all that really is the smart money or the whales accumulating the asset without driving the price up dramatically. So right here, you can see there was an accumulation zone followed by a markup right here. We have this big run up, and then right here you can see obviously this is the distribution phase, right? Now all the distribution phase is the exact opposite of the accumulation phase. It's just the smart money selling off the asset without dramatically dropping the price. So you have your accumulation phase, your markup, your distribution phase, and then this would be your mark down right here, your move down, and then right here would be another accumulation phase, right? So you have your accumulation phase, and then you have that lower low. This would be your spring, right? So you make a lower low, and then, so accumulation, spring, then you have another mark up right here, and then into another distribution phase right here. You could call this like a little mini distribution phase right here with another little markdown. And then right here, I mean, you can consider this another little accumulation phase followed by a markup, another distribution phase, right? So you have all the smart money up here selling without totally dropping the price, and then you get another mark down. Now, this is interesting because you have this little section right here. Now, this would be considered a redistribution, right? So you have your accumulation, your markup, your distribution, your markdown, and then this is your redistribution where people, where the smart money is trying to sell off without moving the asset too much. And then you have another markdown, right? Now, the real million-dollar question right now where we are in the markets today is this going to be an accumulation zone where we accumulate, maybe we come down, make a lower low, that creates the spring, and then we come up higher? Or are we just having yet another redistribution phase and we're going to come down lower? Now, at this point, it's anybody's guess, but it is very interesting to see these play out in markets time and time again. Guys, just to recap, right, you have accumulation, your markup, your distribution phase. All accumulation is the smart money accumulating the asset without moving the price drastically. Then you get your markup. Distribution phase, which is again just the smart money trying to sell off their assets without drastically moving the price. Your markdown, and then you have another accumulation phase, the lower low, with creating your spring, right? So when you're at lows like this and you're in kind of an accumulation phase, making that lower low is it's not always the worst thing in the world. It could indicate that you have a move upcoming. So you have your accumulation, your spring, your mark up, another distribution phase, a mark down, accumulation, mark up, distribution, mark down, your redistribution coming further down, and then right here where we are right now, the question is it going to be another redistribution phase or an accumulation phase followed by a move up? So guys, I think that's all I got for this one. Don't beat yourself up if you don't put all the pieces of this puzzle together right away. This is a very advanced concept, and if you're a beginner, I highly suggest circling back to this idea once you have a stronger grasp on the basic fundamentals. Also, this is not something that is easy to notice in real time or as it's being printed. You'll always see it play out when you go back, but hindsight is always 20/20. So when you go back and look at the charts, you can spot these different phases of the wick-off distribution pattern. An easy way to use this in real time is to first identify the resistance and support during the accumulation range. If it puts in a lower low, it's not always a bad thing. It very well could be a spring. So watch for long-wicked reversal candles and spikes in volume. Once it springs up and breaks out of the predetermined accumulation range, that's your entry to ride up the hill for the markup. Know that it's a waste of time to try to time the bottom and sell the perfect top. The money is made in the middle. If you have any questions on this, let me know in the comments down below, and I'll do my best to get back to all of you. That's all I got for this video. I'll see you in the next one. Frankie Candles out.